Question 31, Flufftort, right? So this is one of the very important question for reconstruction and reorganization. All of you who are watching this video, if you understand this one question properly about reconstruction, you will understand the whole chapter of reconstruction. And hereafter, you will be able to do all the questions just by this one question because everything is covered in this one question. How much the shareholders are going to receive under the reconstruction scheme? What is the effect on the balance sheet? What is the value? How the value is going to change? Whether it's going to improve or whether it's going to get worse. Everything is covered in this. So this question covers various aspects of your reconstruction and reorganization. I will start with the requirements. And this question is very long. It's a 3-page, right? The question is for 3 pages and I'm going to go to the requirements first. So the first requirement is prepare a projected statement of financial position as at 30th June 2006 on the assumption that Gupta VC is the venture capitalist, okay, who exercises his rights and the Gupta VC shares are repurchased and cancelled by the Flufftort company. So here we are going to show what is the position. We are going to make a statement of financial position. It will be a change, right? As at which date is very important, right? When Gupta VC shares are repurchased and cancelled. So this is about venture capitalist. Here the venture capitalist is what? They have a right to exercise. What is that right? That their shares can be repurchased, right? And cancelled by Flufftort company. So if they are going to do this, what is the impact on the financial position? We need to show, and it's for 4 marks. Next we have prepare a projected statement of financial position. Again, a projected statement of financial position as of 30th June 2006. So again, it is a statement of financial position at 30th June. Remember, the date is very important here. Okay, on the assumption that the proposed refinancing and investment takes place. So refinancing takes place. C, the third part for A is, which is again for 4 marks. See, just because it's 4 marks, don't think that we don't have so much of work to do. We have so much of work to do in this 4 marks itself. Okay. Now, project a statement of profit or loss for the years ended 30th June 2007 and 30th June 2008. That means for the 2 years, you have to make statement of profit or loss. Right. This is why I told you that this question is very important if you are preparing for your reconstructions and reorganization. Why? Because this have your financial position, this includes a statement of profit or loss, this also includes your impact on the finance providers, on the various stakeholders, the effect of refinancing. So this is a full-fledged question for your reorganization and reconstruction. To understand it in a better way, this question you need to attempt. And this you have to take not for 2006, for 2007 and 2008. That's why date is very important. On the basis that the profit forecast are correct. Now part B, 13 marks. Here we don't have any calculation, but still some calculations we need to do. Okay, like ratios we might need to calculate, or we can use the figures from the calculator above. For your A part, you can take it in B and explain. Evaluate whether the suggested refinancing scheme is likely to be agreed by all finance providers. This is a very common question asked in your reconstruction question. Very common question. So B, I'm going to take it as, I'm going to put a star mark because this is a very important question. Very common question you can expect in here, and you should know an answer for this. For you to understand reconstruction, what is the impact on the finance providers? whether this refinancing scheme will it be accepted by all the providers, whether it will be accepted by the shareholder, whether it will be accepted by the bank, whether it will be accepted by the venture capitalists, whether it will be accepted by the employees. You need to know it. And it's for 13 marks. That's why the mark if use is very high. It's not just one you are saying. We are taking about various finance providers, all those who are providing finance to the company. It could be your bank. Maybe you're taking a bank loan, venture capitalist, your shareholders, and various other ways. So you need to see whether they are agreeing on this or not. Now, state clearly any assumptions which you make. Most of the time, this is ignored by the candidate. You don't put your assumptions. You just assume the examiner to know. Yes, it's an obvious. They must be knowing, right? You always think like that. Always state even the obvious thing. The most obvious thing needs to be stated. Okay. So now we'll go to the case study. And when you go to the case study once, maybe you might not be able to understand. Maybe you have to go many times. It's okay because you are practicing now. This is not an exam. But when you do this question, when you finally attempt this under your exam, when your time requirement and all, then you need to time it and do it in a proper way. But now, if you are doing this question for the first time, you might not be able to solve it also. Because this question is very lengthy. And what happens is when your case study is very lengthy, by the time you come to the last, you forget what you have read in the first. You're not able to link that first with the last. You cannot, you read the case study as in isolation, not integrated way. So every part of the case study is linked to the next part. It's very important that you read it as a whole and not in isolation. Income statement in one part, balance sheet in one part, because they are asked in different requirements. No, everything is integrated. The requirement, the way it is asked, may be in a different order, but this case study you have to read it as a whole and you need to understand it. So that's why I will go slow on this, because this is a doubt asked by many, and this is a question also where students often struggle to understand it also and also to score well. So we are going to go slow on this. Okay, let's read. 5 years ago, the Patel family invested in a new business. And the name is Flufftort Company. Okay, which manufactures furniture. So this business is in the line of furniture. Some family members became directors, others have not been actively involved in management. A venture capital firm, Gupti VC, which is venture capital, okay, also made a 20% investment in Flufftort Company. So how many investment they made? 20%. Okay, you need this because we saw that in a first requirement itself for 4 marks we need to show the impact on the balance sheet. So a representative of Gupti was appointed to Flufftort's board. The Flufftort also took out a long-term 8.5% bank loan. When we go to the balance sheet, we'll see that there's an 8.5% bank loan also. Okay, here they have just written it in sentence, but we have it in the balance sheet. Now, second paragraph. Okay, so when you read, this is a reading technique I want to tell here. Okay, when you're reading, you might be reading very fast under the exam condition and all, and when you read fast means you forget what is there. You are not doing an effective reading here. You're just reading for the sake of finishing the case study and trying to answer. It will not help you. You have to retain the information in your head, right? When you're going to write your requirements, you have to retain the information what you have read. So the best way to do is, I have applied this and it worked for me, it worked for others as well, and it will work for you too. So you can slowly build this habit. When you read one paragraph at a time and keep a pause. Have a pause. Don't, let's say I finished this one. Okay, also took out a long-term 8.5% bank loan. Sales have generally been. Don't read like this. It will not help you at all. You have to know where to stop, where to start. So first you start with 5 years ago, then you stop with 8.5% bank loan. Mark, underline all the keywords. If you haven't underlined while reading, highlight a note. Okay, what are the keywords where you might be needing all this and all. Pause and try to picture, visualize. Have you understood the first paragraph completely? It might take maybe 1 minute or 2 minutes, or not even more. More than that, it will not take. It shall not take more than that. Have a pause so that you understand the whole scenario, what is the first paragraph is saying. Once you understand it, then go to the second paragraph. Don't just keep reading, no pause, nothing, not understanding anything. It will not help you. It will not go anywhere. Because later, when you try to answer this question, your requirements, you will be very stressed. Trust me, you'll be very stressed. You will be panicking and you don't know what to answer. Which are the keywords should I take from the case study? You will not know. So, all your underlining, annotating, everything, labeling, everything you have to do while you're reading only. Or if not while reading, then paragraph per paragraph. One paragraph you read, look out for all the keywords and everything and do everything and try to understand and then go. Once you understand it completely, then go to the second paragraph, so that again you don't have to revisit it because you have understood the case study itself, right? Now I'm going to the second paragraph. Sales has been generally been disappointing. As a result, members of the Patel family have been reluctant to invest further. Okay, of course, if sale is disappointing, why will they invest, right? So you see how the second line is building from the first line. That connection, it should flow, you should understand. Over the last year, they have taken a tougher attitude towards Fluffed, the company, right? Of course, the venture capitalists will take a tougher attitude towards company. Why is that? Because they are the one who are investing it. And if the sale has been disappointing, if the company is not performing well, then their investment is also at risk for the venture capitalists. So they need to take a tougher attitude on the company. So Gupti has pressurized the company to pay a dividend of $2 million for the year ended 30th June 2005. This information is also given in your income statement. But still, I will highlight it because when you're reading this, you don't know. I have read the full case study, so I know what is there. But you haven't read it. You are reading for the first time. You don't know what is down. So highlight it, underline, highlight. Wherever figures are given, always underline the figures. You need the figures. The figures are not given just for time pass or just for the sake of giving any number. That number is given for a reason. You need to use that number somewhere or the other way. Now, Gupti VC has also said that if the company's financial results do not improve, who is saying? The venture capital is saying to the company that if the financial results do not improve, they may exercise its right. The venture capitalist, they will exercise its right to compel the company to buy back its shares at par on 30th June 2006. Right? This was our first requirement. Right? They told that they can exercise. So now we have given a situation that let's assume they have exercised that right. They are buying back their shares. So what happens? You need to show the impact on the balance sheet. Now let's see. However, the company's most recent product, Easy Question Share, has been a much bigger success, right, than expected. So Easy Question is bigger success. In order to produce enough Easy Question shares to affect its results substantially, that means since they are sale, just see how this is relating to this. Okay, this line relate to this. Sale has been declining. So what happens when sale is declining and when you are a product, when you are having a product who is making a bigger success than expected, what would you do? You will try to invest in that product more. Why? To change your company. You want to turn around the result. Your sale has been declining. It's disappointing. You want to improve it. How will you improve it? By investing in a product which is success. So because they want to affect the results substantially. Right? So they want to invest in Easy Question Chair. To affect its results substantially, the company will need to make a significant expenditure on manufacturing facilities and additional working capital. Yes, you need to invest in your manufacturing facilities and working capital. You need working capital too. Now you have been given extract for 2005 and 6. 2006 is forecast. Right? This is the income statement you can see. Right? We have been told that dividend was 2 for 2005 for year ended 30 sorry 30th June 2005. So this is this 2 million they have been talking about, right? And if you see, your return earnings also increased by 0.4, okay, 0.4. Now let's go to the note. Always read your notes. Your note is very important. Somewhere some hint is given in this note only. You need to read it. Okay. So the forecast statement of profit or loss for the year ended 30th June 2006 is not affected by the proposed investment. You see, your profit or loss, it is not affected by that proposed investment in the new easy cushion share. So this can be assumed only to affect results after 30th June 2006. That means 2007 and 2008, right? We have been told to make a profit and loss account for 2007 and 8. Only it will affect those results after 30th June 2006. And this is, if you see this one, it is till 30th June 2006 only, right? It is till 30th June 2006, so it will not have an impact on this profit or loss. So it's a good thing. The figure, the important thing is here. Okay, I will tell you why when we go through the answer, why we need this. Okay, so the figure shown for the retained earnings in 2006 forecast can be assumed to be the net increase in cash for the year ended 30th June 2006. This retained earning, right? It is 2006 forecast retained earning, and they are telling that this is assumed to be the net increase in cash. So this is the net increase in cash for 2006 only. Okay, now we have been given the financial position, right? You can see we have non-current assets, we have cash, and then current assets excluding cash, we have share capital return earnings, 8.5% bank loan, 9% loan note, and we have current and long-term liabilities, right? So now let's read the notes. Since I have gone through this case study, right, we only need to read note 1 for our first requirement. We don't need to read others. Others are coming for second requirement, which is when refinancing takes place. What is the impact on the financial position? But since you haven't read this, you are reading this for the first time, I'm going to read the entire case study in full and then I'm going to attempt the requirement. Because when I do, even for the exam also, I don't know, right, how much I need for first requirement and all. So it's better to read the entire case study in some cases. In some cases, it is clear cut that you only need some portion of the case study for this requirement and the next portion for that the second requirement, you know it. Subheading is given or some link is given. Here, you are not given anything as such. You're just given income statement, balance sheet, that's it, and some notes. So in this condition, you need to read all the notes and then work on your requirements. So first note is 55% of shares are owned by members of Patel family who are directors, 25% who are family members, right? But who are not directors, right? They are other members of the Patel family, and 20% by Gupta VC, right? So if you add up the whole 55 plus 25 plus 20, it should add up to 100%. This you need to remember. 25% Patel family directors, 25% other members, and 20% by Gupta VC. Earlier also we saw 20%. Now the second one, bank loan. So they are talking about this 8.5% bank loan here. The bank loan is secured on the non-current assets of Flufftort. That means when you're taking out a bank loan, of course you have to give some security to the bank. What is that security you are giving to the bank for taking the bank loan? That is your non-current asset. Non-current asset of Flufftort. And it is due for repayment on 31st December 2009. Why they are giving this repayment date? This repayment date is always given for you to decide whether it's a non-current liability or a current liability. That is the only purpose of giving you the repayment date. So the repayment date is 31st December 2009. That means this is when? This is 2005 balance sheet. That means it's a long-term liability. 4 years from 5 to 9. Now, the loan is subject to a covenant that the ratio of the equity to non-current liability should be greater than 1.3 on a book value basis. So this is the covenant. Very important is equity to non-current liabilities should be greater than 1.3 on a book value basis is very important. That means your equity has to be more than your non-current liabilities and the ratio has to be more than 1.3. That means more than 1.3 is to 1. It cannot, if it's less than 1.3, right? If your equity to non-current liabilities, that ratio is less than 1.3, that means you are breaching the covenant, the loan covenant, right? Of course, when you take a loan covenant, there are some covenants, some terms and conditions of that loan which you need to accept. Flufftort has also been granted an overdraft facility of up to 5 million by its bank. So 5 million overdraft. Okay, now come to the loan note. If you can see from the balance sheet, 9% loan note is 5 million. Let's see. Loan note is held by Rajiv Patel, a member of the Patel family who is not a director. This you need to understand. Because you need to talk about the finance provider, right? So loan note is held by whom? Not a director. Is a member, but not a director, other member. Because you need to know the share, how much they're holding the loan note. The loan note is unsecured, subordinated to the bank loan, and has no fixed debt for repayment. So that means it's not so much safe. It is risky because it is subordinated to bank loan also, and it is not secured, unsecured. Loan it is unsecured. Next, fourth point. If no finance is available for investment in manufacturing facilities, right? See, we need finance. By the time you come this point, you forget also why we need finance and where are we investing. Don't worry, it happens to many of us. It even happens to me also. So it's okay if you are in that stage. Later, when you practice as more and more questions you practice, the lengthy questions, the small questions, the medium-sized questions, you will be able to cope up with this pressure and you know by that time how to handle such questions. But when you're attempting this question for the first time, you will might not be able to do it. You might not be able to do so much justice with it, right? It's okay because it's a very lengthy question and so much of information to remember here. And everything is important. The worst is everything is important. You cannot even say also this is important, this is not important. Okay, so now if no finance is available for investment, what investment? Easy question share, right? It's a product of a success. We need to invest there. For that, we need finance. So they are saying what happens if no finance is there to invest? Or if no finance is available for investment in manufacturing facilities, not only manufacturing facilities, we need to invest in non-current assets, current assets excluding cash, the bank loan, the loan note, and the current liabilities can be assumed to be the same at 30th June as at 31st. So it will be same. Non-current asset will be same, current assets excluding cash will be same, bank loan will be same, loan note will be same, current liabilities will be same. If no finance is available, it will be same only whatever is given in the balance sheet. We have been given the balance sheet for all these items for 30th June 2005. Same value we can even take for 30th June 2006 also. Can be assumed it is same if no finance is available. Now, however, the chief executive and the finance director of the company intend to propose that the company should be refinanced to fund the expanded production of the easy cushion shares. So they are coming up, the CEO and the FD, the finance director. What are they saying? They are saying that it's better to go for refinancing, right? Refinancing or reconstruct the reorganization, in any term you can say. It's better to go for that. Why? Then we can get some finance to invest, right? So they have not yet consulted anyone else about their proposal. Details of the proposed refinancing. You have to go through each details of the refinancing. Right? You have been given six points, all the 6 points. Okay. So first, the members of the Patel family who are directors. Okay. So members of the Patel family who are directors, how many percentage they are holding currently? Go up and see they are holding 55% of the share. So they would subscribe to an additional 15 million shares at par. What happens? Now they are going for additional shares. So more shares will come in the balance sheet if you show. Right? We'll see what is the percentage holding. Will it remain same, will it increase, or will it fall down? Now, second one. So Gupti, this is they're talking about the venture capitalists. They would subscribe to an additional 20 million one share at a par. So now you see your shares are increasing from first one also, from the second one also. So Gupti will subscribe to additional 20 million at a par. And here they would additional 15 million. Next, third one. And currently how much they are holding? Currently Gupta is holding 20%. Third. See, this is what I'm saying, I'm annoting it. I'm writing next to it somewhere. That is 55% or 20%. What will this do? This will help me. When I do after the change, after refinancing, when I do the balance sheet, it will be very easy for me to show the change because now I know. I don't have to go up and find for the percentages. How many percentage she is holding, how many percentage the venture capitalist is holding. 3. 8.5% bank loan will be renegotiated with the bank and the borrowing increased to 65 million. So borrowing is increased to 65 million for this 8.5% bank loan to be repaid on 30th June 2000. Y2 is 12. So that means it's a long-term loan, right? And you have to, what about the interest? It's a long-term loan, you have to pay the interest also, right? It's finance cost. So the expected finance cost of the loan would be 10% per annum, 10% per year only. Okay, that means 10% on 65 because 65% is the loan. So 10% of 65 is 6.5. Now let's go to the fourth one. Rajiv Patel's loan note would be replaced by $5 million one share. Very, very important. Loan note. We had that 9% loan note, remember? Now that loan will be cancelled and it will be converted to shares. 5 million $1 shares. It will be replaced. So loan will fall down, share will increase. Okay. Fifth one. The refinancing would mean non-current assets would increase to 125 million. So non-current asset increased to 125 million. Current assets other than cash 42 million. Current liabilities 12 million would increase to. This two word is very important. Not by. You always have to see whenever some change or increase or decrease is given, whether it's increased to or increased by. Here they are saying it would increase to 125. That means in your balance sheet, it will be 125 only, non-current assets. 6. Okay. Let me give a scenario also. Let me clarify this very here itself. Okay, let's say there are two. Currently, your balance sheet has 100 of non-current asset. Okay, currently your balance sheet has 100 million worth of. Okay, this is in million worth of non-current asset. Now they are saying non-current asset would increase 225. 2. Okay, we'll keep as it is same. That means now it will not be 100, it will be 125 because the word is 2. 225. Whenever it's 2, the amount itself you can keep it. Now another scenario is it is given by 100 and they are saying it would increase by 125. By 125. So by, again I'm writing 100 here and it's saying it's increased by 125. Add 125 to 100, it will be 225. So by means you add with the previous amount and then put 2 means the amount itself you can put it. That is the difference. So here you don't have to add it. Just the amount you can write 125, 42 and 12 because it is increased to 6. Operating profits would be expected to increase to 20 million. See, operating profit is given because you have anyway have to make profit and loss for 2006 and 7. Sorry, 7 and 8. Right? So that's why this operating profit is given to you. It would increase to 20 million in the first full year after the facilities are constructed, that is June 2007, and 25 million in second year, that is 2008. So operating profit 20 million in 2007, 25 million 2008. Next, no dividends would be paid for this 2 years. No dividend 2 years. Which 2 years? 6 and 7. Sorry, 7 and 8. As cash surpluses. Why they will not pay dividend? As cash surpluses will be used to further invest as required. So the cash surpluses will be used for further investment as required. They will not pay it as a dividend. And tax on company profits would be assumed to remain at 20%. So tax is 20%. Okay. Whenever you read something, stop there and try to talk with yourself in your mind. Why this piece of information? What does it mean? Why operating profit is given? For me to find profit or loss. Why this figure is given? For me to find the balance sheet amount. So like that, once you do it, you will be able to understand it better. And you will never forget it also. Now we know that first requirement, they are saying that venture capitalists will exercise their right and Gupta shares will be repurchased and cancelled. So we'll see what is the impact on the balance sheet. Directly we'll go to the balance sheet. Non-current assets will remain 69 only. Same as it is. Okay. Your your current assets excluding cash will be 18 only, but your cash will not be there. Why? Because that cash you are using for investment. You are using it to purchase the shares, right? Repurchase the shares. So that cash is used there, cash reserve. So cash will be blank. Share capital will reduce. Before it was 50, now it will be 40. Why? Because 20% of 50 is 40. You have to deduct this 20% from 50. So 20% from 50, it is 10. So 50 minus 10 is 40. Or you can just take 80% also. Retained earnings, how we got retained earnings? 5. Okay, we'll take it to the balance sheet first. Just see, your non-current assets will be 69, current assets will be 18, and cash, there will be no cash. Share capital was 50, but you have to take 20%, you have to deduct. And then your return earnings, if you see here, it is 2.6, right? And here they are told somewhere. Okay, so this is the net increase in cash, the retained earnings, this 2.4. So what happened is you have to add this 2.4 here because it is a net increase in cash. So it will be 5. That's why your return earnings is 5. Right? If you see here, return earning is 5. So this also understood, this also understood. Next, come to your bank loan. Right? Your bank loan, okay, we'll take it to the balance sheet. Bank loan will remain 30. This one will remain 5. This will be 7 only. So you are getting 42 as total liability. Are you getting total as 42 here? Yes, you are getting 42 here as well. This, just check. 30, 35, 7 and 42. And it has to be balanced. 87 and 87. It needs to be balanced. Balance sheet. Right? Now, let's go to the second one, right? Second one, what we have to do is, they are asking is, prepare budget statement of financial position at 30th June if refinancing takes place. So 30th June 2006, okay, we'll start from the non-current asset. So non-current asset will increase to 120. We have been written here where 125. So your non-current asset will be 125. Okay. So just we'll go to the balance sheet and see non-current asset as 125. Current asset, they told it will increase to 42. Cash, this is a balancing figure, right? When you try to balance your this and this, 172 and 172, then this is a balancing figure. This you should get. Your share capital, just see. Your share capital here, it was 50. Sorry, here it's 50, right? It will now increase. How it will increase? We'll check here. First, let's take the first one. Additional 15 million. Add that 15 million. So 50 plus 15. Go to the second one. Again 20 million. Add 20. Go to the third one. There is no change in cash share. There's no share. It's only your borrowing is increasing. So third is not relevant. Fourth one. Loan note is replaced by 5 million shares. So add again 5. Right? And just check the total. Right? For 5 and 6, 5, they're just saying what is the increased amount, and 6, they're talking about the operating profit, nothing about share. So your share, if you add all, it will be 90 now. It is increasing by 40 from 50 plus 40, 90. So your share capital will be 90 here. If you see, your return earnings will be 5 only. Because in 2006, your return earning is 5. Just see here. You have drawn a statement for 2006. Return earning is 5 in 2006 only, right? So here also it will be 5. Retained earning will not change, it will remain 5 only. Then come to your bank loan. Bank loan here it is 30, but here they told that when you go to your third one, they are saying borrowing increase 265 million and your loan note is replaced. That means no more 9% loan note. It will be now share capital. So that's why here if you see the balance sheet, there is no loan note. You're not going to write 0, just a dash. And bank loan is 65 because it is increased to 65. Right? Current liability, they told it will be 12. And then rest all. And then it will balance. Now let's go to the third one, projected statement of financial profit or loss for both 2007 and 8. Operating profit has been given for 2007. I have underlined it. Please go check. 20 and 25 for 2008. Financing cost we calculated. Borrowing was 65, right? Borrowing is 65, so 10% of the 65, it will be 6.5 only, right? So it's 6.5 for this year. Next year also it will be 6.5 only because annually per annum it is 10% of the finance cost of the loan. So it is 6.5, 6.5. Profit before tax, tax is 20%, calculate 20%, and profit after tax you will get. We have been told no dividend for the 2 years. That's why it is underlined, right? No dividend. And then you are getting the retained earnings. Now, part B. Part B, we need to talk whether this is accepted or agreed by all finance providers, this refinancing scheme, right? So first, what is the current situation? Whenever you have to talk about refinancing, restructuring, whether it is accepted by all finance providers or not, start with current situation. Start with current situation always. What is your current situation before refinancing? First talk about that. So what is your current situation? Briefly summarize your case study. That's it. That is your current situation. So initial product developments have not generated revenues. We saw that sale was declining, required to sustain growth. But the new Easy Question share appears to offer the company much better prospects of commercial success. At present, however, the company does not have the resources to make the investment required. So they do not have the finance to make the investment currently. Right? Next. Second, purchase of GupTV shares. So we are talking about this, right? What is the next line? I don't know why it is not, why my pen is not working. This is the most annoying situation, right? When your pen doesn't work. Okay. Okay, so it is the purchase of Gupti V share. So we are talking about this. If you go up and see, we are talking about the first requirement. This requirement. What happens when Gupti repurchases shares? Okay, so we are talking about that. Put it under separate paragraph. Use a subheading. First, you start with current situation, then you discuss with that requirement. What happens when they purchase shares? The venture capitalist. Put a subheading and write it. What happened there? In the worst case scenario, they will demand. See, venture capitalists, they usually don't demand for the repayment of the investment. They do it only in a worst case scenario. This is a worst case scenario because your sale is declining. They have been seeing sales which is disappointing. That's why they are demanding it, right? So in the worst case scenario, you need to say also which scenario, in which scenario they will go for such, they will demand for the shares, the venture capitalists, right? Only in a worst case scenario, when the condition is good, they will not do it. They'll be happy to invest. So in the worst case scenario, Gupta VC will demand repayment of its investment in a year's time. The calculations in A, you are not going to do calculations again here. Don't repeat your same calculations here. Already you have calculated, you are just going to refer it. How you are going to refer? You can say calculations in part A. That's it. It shows the financial position in a year's time because we did a balance sheet, right? Financial position only we drew up. Assuming that there is no net investment in non-current assets or working capital. So this, you need to state your assumptions. Remember they told state your assumptions. So this is one of the assumptions. No net investment in non-current assets or working capital. This could be one of your assumption. The purchase of shares is a financial, okay, is financed. How this purchase of shares is financed? Solely out of cash reserves. And the shares are cancelled. Shares are cancelled. Repayment by this method would mean that the limit, okay, what is the repayment? Repayment by this method would mean that the limit set out in the covenant would be breached. I told you 1.3, it has to be more than. Equity to non-current liability should be more than 1.3, otherwise it is breached. Here it is less than 1.3. Here it is 1.29. How 45 divided by 35? We'll go and check why 45 over 35. Go to part A. Your total equity is 45. Your long-term liability is 35. So 45 to 35. 45 divided by 35. It is 1.29. Is it breaching? It is breaching because it has to be more than 1.3. And the bank could demand immediate repayment of the loan. Exactly, because they are breaching the loan. What happens? Now it's a long-term loan, but now they are breaching, right? The covenant. In this condition, what bank could do? They could demand immediate repayment of the loan. You need to come up with the scenarios. You need to tell if this happens, what happens. If this happens, what they could do or what they will do in such situation. This is how you build up points for reconstruction questions. Now, second paragraph. The directors can avoid this by buying some shares of Guptiware shares themselves. Okay, but this represents money which is not being put into the business. In addition, the amount of shares which the directors would have to purchase would be greater if results, and therefore reserves were worse than expected. Okay, so if they are saying, let the directors buy the shares of the Gupta shares, what happens now? The directors will have more shares now. They will have more shares to purchase. So since they have more shares to purchase, where will they purchase these shares from? They will take from reserves, no? So the reserves will get affected. Reserves will be worse than expected if the directors avoid. Directors buy the shares. Why directors will buy the shares? Because you are breaching no 1.29. So directors can avoid this 1.29 by they themselves can buy the Gupta VC shares. But what happens is even if they buy the Gupta VC shares, what happens? Reserves will get affected because they have to purchase more now. Now let's go to the financing the investment. This is your second requirement. See how you are using subheadings. You need to use subheadings like this. And then you need to write in paragraphs. Because it's 13 marks. 13 marks is not just given like this. Everything needs to be broke down and you have to write it in paragraphs. Next, here also they are referring to A only. So calculation in A show that the cash flow associated with the refinancing would be enough to finance the initial investment. They are saying that the cash flow that you are getting from the refinancing will be enough to finance the initial investment. We'll see why they are saying it. Ratio. See, you need to calculate some. Just because it's theory, don't assume that you just have to write sentences and no, you need to do some calculations, some ratios. This is financial management subject. Finance. You need to talk about finance. You need to bring about numbers. Even in theory part. So the ratio of equity to non-current, now calculate ratio of equity to non-current liabilities. After the refinancing would be 1.46. This is good. It is more than 1.3. We'll see how. 95 to 65 because now your total equity is 95. Long-term loan is 65 only. So 95 divided by 65 is 1.46. In line with the current limits in the bank covenant. So that means this financing is good in a way. However, this word is very important. You are saying it's in line with the covenant, but there's a problem also with that. Financing for the subsequent investment required would have to come from surplus cash flows. Surplus cash flows only this financing will come. Now, another very key word, key thing which you need to do when you're doing a reconstruction question or reorganization question is, and when you need to talk about different finance providers, whether it is accepted by all or not, is this thing. This thing needs to be done. This table has to be there. What is the shareholding percentage and number of shares before the refinancing? What is the number of the share and the percentage of shareholding after refinancing? This has to be there. This itself will give you around 3 to 4 marks. So it is shareholdings. Disposition of shareholders will change. We'll see. So percentage will be 100 only, and we know that number of share before refinancing is 50 only. From the balance sheet you will get out of this 50, right? 55% is director, 25% is other, and 20% is your venture capital. So 55% out of 50 you take, right? This is 55% out of 50. If you take, you are going to have 27.5. That means 27.5 million worth of shares is with the director. You just know the percentage, by the way, out of this 50, but we now need to break down how much directors have, how much other family members have, how much the Gupti VC have, and how much the loan note holder has. So in the current shareholding, loan note holder does not have anything because the percentages are in the three categories: director, other family members, and VC. So we can see 27.5, 12.5, and 10. Now let's go to the shareholdings after refinancing. We saw that it is now 90, right? It increased by 40 from 50 to 90. So now when you take the percent shareholding, it will be from 90. Now, but this percentage, this 47.2, 13.9, this needs to be calculated, right? We are not getting it as it is. How we are getting it? Let's go to the director. One by one we'll go. Okay, but percentage will be 100 only. There's no doubt in that. How we are getting for that? First we'll work line by line. First we'll work for the director. It is 27.5. So for director, let's go up. Sorry, it's not here. It's like this. Okay, let's go to the first point. They are saying members of the Patel family who are directors who subscribe an additional 15 million. That's why you're adding 15 million to this. We're adding 15 million to this 27.5. So this is 27.5 plus 15, you are getting 42.5. Let's go to the other family members. Other family members, if you see, it will be 12.5, 12.5 only, no change. Gupti Visi, they are subscribing an additional 20 million. That's why it is, before it is 10 plus 20. That's why it is 30. And now we have a loan note holder also. After refinancing, if you see, it is 5. We'll see how. Okay. So here if you see we have a 5. Here. So Rajiv Potter's loan note would be replaced by $5 million one share. So they are taking that 5 million here, the loan note. It will increase by it will be converted to shares. No loan note, it will be replaced as 5 million shares. So that's why it's 5. And now you know how to calculate the percentage. How will you calculate this? It will be 42.5 over 90 into 100. You are getting 47.2. Likewise, you can calculate all the percentages. And now you need to compare the percentages. What happened in the first thing? From 55, it fell to 47.2 for the director. Is it good? It's not good. They're losing control. Other family members also from 25 to 13.9. But venture capital is from 20 to 33.3, it is increasing. And loan note also 5.6, from 0 to 5.6. So now basically that comparison we are putting in sentences only. So Gupta versus percentage shareholding will rise from 20 to 33.3. Enough possibly to give it extra right over the company. Directors' percentage shareholding will fall from 55 to 47, which means that collectively they no longer have control of the company. How much you need to have the control? 50% at least. You are having less than 50 now. So no longer control of the company is there. The percentage of shares held by family members who are not directors falls from 25% to around 19.5%, taking into account the conversion of loan note. That means they are saying that this 19.5%, the way they have calculated is other family members is 13.9 and loan note is 5.6. So when you add, it will be 19.5%. So from 25, okay, it is falling to 19.5, taking into account the loan note also. This will mean, however, that the directors can still maintain control if they can obtain the support of some of the rest of the family. See how much percentage you need. You at least need 20 percentage, right, to maintain control or to have an influence. So out of that 20, you are currently having only 19.5%. Just means you only need 0.5% more, so that you can get from the rest of the family member, right? You can take the support from them and get some of the shares from them and get that over 20%, and you can maintain control. Now position of the finance providers. This also has to be there at the end, right? And then your conclusion. And if you see it's very pretty long, right? You cannot even write this much in your exam, but it's okay. We'll just go through the points. Here they have explained it in a very elaborated way. But when you write it, please write it in very simple terms. Okay, don't try to elaborate so much also. Stick to the marks, 13 marks. Now, so position of the finance providers. The refinancing has been agreed by the chief executive and the finance director. This we have been given in the case study itself. They are the one who think that it's better to refinance. So we know that it has been agreed by these two parties. At present, it is not clear that the views of what. See, at present, did they tell that any of the directors are not agreeing or agreeing? Nothing has been mentioned in the case study. So that's why they are saying when nothing has been mentioned to you in the case study, you are very free to say that it's not clear from the case study. At present, it is not clear whether what the views of the other directors are or whether the 15 million contributed by the directors. This is contributed by the directors, right? Will be raised from them in proportion to their current shareholdings. So nothing is clear. Some of the directors may not be able to or wish to make a significant additional investment in the company. Yes, it is clear that some of the directors they might not want to make an additional investment. Why? they were losing their control. They don't want to lose that control, right? From 55 to 47.2 it's falling. On the other hand, if they do not, what happens if they do not do? They do not make additional investment, their shareholdings, and perhaps their influence within the company will diminish. Within the company will diminish. Why? Company is anyway not performing well. Sale is declining. So this may be a greater concern than the board collectively losing control over the company. Exactly right. If you're losing the company within the company, it is a greater concern than the board together collectively losing control over the company by investing. So since it may be unlikely that the other shareholders will combine to outvote the board. Now, the other family shareholders have not been actively involved in Flufftort's management out of choice. Right? They have been told that some of the family members they are not actively involved in the company, in the management of the company. That is due to their choice only, out of their own choice. So because they are not actively involved in the management of their choice, what happens is a reduction in their percentage. Shareholders may not be an issue for them. Exactly. If someone is not interested in the operation, you think that if their share price reduces, they'll be interested. It will not be an issue for them. Right? So they may have, so what happens is if it's not an issue for them, you can say that they're more likely to accept this. They may have welcomed the recent dividend payment as a generating a return on their investment. Now, however, as they appear to have invested for the longer term, the new investment appears to offer much better prospects in a form of capital gain on a listing or buyout than an uncertain flow of dividend. Right? So the new investment appears only to have an upside for them in the sense that they're not being asked to contribute any extra funding towards it. See, the shareholder, the directors who are not participating, okay, involved in the management of the company, they are not being asked to contribute any extra funding, right, for the new investment. So this new investment is an upside for them. Now Rajiv Patel is unlikely to be happy with the proposed scheme. Why is he unhappy? Why is he unhappy? We'll see. Oh, unlikely to be happy. Yes, unlikely to be happy means unhappy only with the scheme. Why is that? So, this is how you bring your stakeholders, your finance providers. Rajiv Patel, you need to talk about the venture capitalist. You need to talk about those directors who are not family members, family members who are not directors and family members. So, you need to talk about all this in different paragraphs and also about the bank. So, all these are your finance providers. And this you can put in different paragraphs. Bank, venture capitalist, Rajiv Patel. Now we're talking about Rajiv Patel. Okay. He is exchanging a guaranteed flow of income for an uncertain flow of future dividends sometime after 2008. Why is that? How is he exchanging unflow of income? That means he is changing his loan note to share capital. What happens? Loan note, you are getting a fixed interest, right? You just have to pay a fixed interest. You know, you can predict with certainty. Interest is fixed. But what about dividend? It is uncertain. You don't know how much amount you can receive. You will be getting it. So you are exchanging it. A guaranteed flow of income for an uncertain flow of future dividend. Okay, on the other hand, this investment may be jeopardized by the realization of the worst case scenario since his debt is subordinated to the bank's debt. This investment might not be a good investment. Why? Is because debt is subordinated to bank's debt. Right? We told that it is unsecured. 9% loan note. Remember, it is unsecured. It is subordinated to the bank's debt. So that's not a very good thing. Now, we'll go for the venture capitalist. The next paragraph. The most important issue for the Gupta VC's viewpoint is whether the extra payment required is likely to yield a better outcome than the return of its initial investment in a year's time. Right? They want to see whether the extra investment required, right, it is likely to have a better outcome or not. So the plan that no dividends would be paid until after 2010 is a disadvantage. They told that no dividend will be paid. Why is that? Because the return you're getting, you're not certain, right? You're not sure how much return you're going to get after the investment. And you're not getting a dividend also. Yeah. And about the income also which you're going to receive, you're not sure. So it's a disadvantage. On the other hand, the additional investment seems to offer the only prospect of realizing a substantial gain by Flufftort being either listed or sold. Okay, the arrangement will mean that Gupti may be able to exercise greater influence over Flufftort. So arrangement means this refinancing means that Gupti can now exercise a greater control over the company, which may provide it with a greater sense of reassurance about how the company is being run. So because now they can exercise control, venture capitalists, they can be more reassured about the how the company is being run. The fact that the Gupti has a director on the Fluff company's board, this they have taken from the case study. Clearly from the case study, in the first few lines you will see that Gupti VC has a director also on the Fluff company's board. What happens because of this should also give it a clear idea of how successful the investment is likely to be. Because they have some director, now they can be more sure about how successful the investment is going to be. Now let's go to the bank. The last paragraph is about bank. Bank is also a very important finance provider. From bank also you are going to get finance. Bank loan we have. So the bank will be concerned, okay. Now you think from the bank's point of view. Now you're in the bank. You're going to give a loan to the Flufftort. What happens? Bank will be concerned about the possibility of the company breaching the covenant limit and may be concerned whether the company is ultimately able to repay the full amount without jeopardizing its existence. Okay, so the bank will be concerned if the company tries to replace the loan finance with overdraft finance. Okay, the refinancing provides a reassurance to the bank about the gearing levels and a higher rate of interest. The bank will also be pleased that the level of the interest cover under refinancing is high and increasing. 2 in 2006. Okay. Okay, so 2 in 2006, 3.1 in 2000 and 3.8 in 2000 we'll calculate now. How that interest cover is increasing. That if the interest cover increases, it's good, right? However, it will be concerned about how company finances the additional investment required if cash flows of the new investment are lower than expected. So now the bank will also be concerned that if the cash flows are lower than expected from the investment, from the new investment, how can the company finance its loan? Can the company pay back its debt? That is also a concern of the bank. We are assuming that the cash flow is this much we are going to receive and we are going to pay back the loan. But what if the cash flow is not that much? It is lower than that. How are we going to finance then? All these are the concerns of the bank, and therefore, in those circumstances, Flyweight may seek to draw on its overdraft facility. Right? They may want to take overdraft facility. Now we'll see how the interest cover for 2000. We can get it from here. For 2006, because we have been given the profit or loss for 2006, right here, focused. So it is the operating profit divided by finance cost, 6 divided by 3, which is 2. Now, for 2007 and 8, you need to go to your answer. This 2008, it is 20 divided by 6.5. And 2008, it is 25 divided by 6.5. You will see it is 3.1 here and 3.8. So you see it is increasing, that which is good. And also here they told somewhere that the refinancing provided to the bank about the gearing level and the higher rate of interest. Why higher rate of interest? Because now your interest rate, if we calculated it as 6.5%, right? Before, if you see your interest cover, your interest rate, right? it was here 3.3. Now it is 6.5. Before your interest was 3, your finance cost. Now it is 6.5. So it is great. The bank will be happy with it. They are reassured after the refinancing. And also the gearing level. Because we saw that with the total equity to your non-current liability. And it's more than 1.3. So we are also sure about the gearing position as well. Now let's go to the conclusion. We are done with all this. This is how you have to answer your question. Exactly the same way. The only thing is the names will be different, the numbers will be different. But the way of presenting will be same only. Let's go to the conclusion. Who are the key players? The key players in the refinancing are Gupta VC, that is the venture capitalist, the bank, and the directors, other than the chief executive and the finance director. Now you are summarizing everything what you have discussed throughout. So if they can be persuaded, then the scheme has a good chance of being successful. If this groups, okay, if you can persuade them, then the refinancing can be successful. However, Rajiv Patel could well raise objections. He may be pacified if he retains the loan note. Right? We'll see how. Let's say he's retaining the loan note, what happens? He'll be in a worse position. If he retains the loan, even if he retains the loan note, he'll be in a worse position. This would marginally breach the current covenant limit. It will breach. How? 1.29, 90/70. Although the bank may be willing to overlook the breach as it is forecast to be temporary. Even it's breaching the bank, what happens is they may be willing to overlook this because it is temporary. So alternatively, the refinancing would mean that the company just had enough spare cash initially to redeem the loan note, although it would be more dependent on cash surpluses after the refinancing to fund the additional investment required. Right? Now we'll see how they got this 1.29, 90/70. Okay. So we know the total equity from our balance sheet here, it was 90. Okay. We are only taking our share capital, which is this 90. Divided by 60. How 60? Here bank loan is 65, and let's assume we are retaining the loan note. We are not changing it to share. So that means we are having this loan note here as 5. So 65 plus 5, 70. That's why 90/70. We are seeing what happens if he retains the loan note. Rajiv Patel. Even then also if he retains it, he is breaching the covenant. But if he goes for the refinancing, he's not breaching. So that's it for this. This is how this answer has to be presented, and by end of this video you should be able to know how to calculate, how to show your income statement, your balance sheet, how to show the impact on different stakeholders. I'm going to take you through the marking scheme, very important. So first one, about venture capitalist, right? If share purchase are purchased and cancelled, this is how you have to do. What is the impact on the shares and other assets? What is equity and what is liability? 2 marks, 1 mark. That's how you're getting your 4 marks. If full refinancing takes place, cash and other assets, 2 marks. Equity and liability will change, 1 mark. Next, 4 marks for 2007 focused, for 2008 focused. And for part B, it is 13 up to 2 marks for each well discussed point. So this is how your marking scheme is, and that's it. Don't forget to subscribe to this channel for more of these videos, and do share this content with your friends. Thank you and take care.